Okay, let me share my screen. Okay, hello everybody. Welcome to our Global Economic Outlook 2020 webinar. Now, some of you here tune in very early today to secure yourself a seat in this very interesting webinar because, as you know, 2019 has been fairly challenging as well, with a lot of critical issues such as Brexit, such as the US-China trade war, and the European banks issue negative yielding bond with the inverted yield curve. So 2019 has a series of negative indicators pointing to an economic recession. But so far in 2019, market still going up. Okay, still charging, the bull is still charging very high, that now the Dow is very close to 30,000. Okay, so will it break 30,000 in 2020, or will the risk of a recession become bigger in 2020? How will the US presidential election turn out in the November 2020? And we started this year with a very interesting headline, which is an Iranian general was killed in Baghdad, which is Iraq uh, soil, and this has caused the market to go down, and also the oil, gold, and silver climbing up. Okay, today gold gap up open so high that I think the highest it closed is 1,500 and near $80 per ounce. So how will this turn out to be in 2020? Will the risk of recession higher, or will the US president election push the market higher that Dow can break 30,000? This is what we will discuss today. And today we are very happy and honored to have Mr. PC Wong to share with you in this Global Economic Outlook 2020. Now, this is what we will cover as what we described in our learning points. Number one, we will talk about global GDP. We will share with you how the global GDP is it contracting or is it expanding. Then we will assess the global debt that we have at the moment. We will talk about major countries. Of course, we won't talk about small countries. We'll talk about major debt in the big countries. Then we'll talk about, explain to you what are the negative yielding bonds. Some of you may not have understood the idea of negative yielding bond. That's what we will explore today. Then we'll talk about global trade. After trade war took place, what happened to global trade and the global purchasing manufacturing index? Is our manufacturing sector expanding or contracting? Then we will assess one of the critical issue where US President Trump said that they're going to sign a deal on the 15th January on the phase one deal. We will dissect about that deal. Then we will talk about geopolitics and oil. Of course, we will touch fairly about Iran. Then we'll talk about possible monetary reset. Then last part of the Global Economic Outlook 2020, we'll talk about wealth protection and return to asset with yields, okay, with income streams. So after that, we will share with you one of the programs that we have. Of course, if you find this program useful to you, then of course, by all means, you may subscribe to it. All right. So that's our agenda for today. Now, as usual, disclaimer: whatever we share is only from our research, and we don't recommend any buy or sell to any equities or any stocks or any futures or any financing instruments. Okay, if you decide to buy or sell anything, you do it at your own risk. Allow me to introduce to you the speaker online today, and he is PC Wong. Okay, he graduated from NUS in 1989. He has more than 27 years of working experience in several public listed and multinational companies. He is also author of 2 bestseller books, in which one of it is Invest in Foreign Shares, which reached popular top 10 non-fiction bestseller in August 2014. He is also a full-time investor, author, trainer, and have been investing in Bursa and international markets since 1995. He's also invited speaker by Bursa Malaysia and also many investment banks and stockbrokers such as UOB, Hong Leong, RHB, Kenanga, and Inter-Pacific Securities to train their retail clients in investing, not only in KL but also in Penang, in JB, okay, in throughout Malaysia. He also appeared on several media and featured in the column in Sinchu Finance segment. So here are some of the interview and also some of the articles that he have written for Sinchu. And if you don't know this speaker, PC, he actually spent 8 hours a day reading news on macroeconomic and also reading corporate news. Okay, not only in Malaysia but also in the US, in China, in Hong Kong, in Australia, and in UK as well. So he's a full-time investor. He spent his day every day at least 8 hours listening to podcasts while researching news online. Okay, reading and dissecting news both from alternative media as well as on mainstream media. So he has both sides of. He not only have a biased position on the mainstream media, but he also read alternative media so that he can get the other side that the mainstream media is not reporting. Because sometimes we know that mainstream media could be a bit biased in promoting a certain agenda. All right, so are we ready? So let me hand it over the session to PC. Okay, PC, you may share your screen right now.
Okay, first we'll talk about the global GDP. Now, this is the latest IMF forecast, and you can see that between 2018 to 2019, the IMF has forecast a drop from 3.6% to 3%, and then in 2020, it should inch back up to 3.4%. Advanced economies seems to be very fixed at about 1.7% this year and next year, and a lot of hope rests on emerging market to reach from and developing economies from 3.9% to 4.6%. But is the IMF painting a very rosy picture? So this is what I think. Now, the IMF forecast is always based on best case scenarios. And as far as we know, the situation is really not so good. Now, despite the phase one deal, many tariffs are still in place. So question remains how China can commit to purchase up to $50 billion worth of agriculture from the US. Worse, the trade war is morphing into a tech war and ideology war. You can see that in these last 2 years, there is a lot of propaganda news outside coming out from the Western media that demonize China, okay? And this is part of an ideology war. It all started when in 2018, the Pentagon and the National Security Agency came out with a white paper and predicted that China would overtake US in 2030 to be the world's largest economy, and by 2035 would outspend the US in terms of military, based on the current trend of spending in their as a percentage of GDP. So that is why that caught the US off guard, and since then they have been ramping up a lot of propaganda against China. And that is also at the same time when the trade war becomes a much deeper ideology war as well as a tech war. We can see that from the tech war side, US has banned a number of Chinese companies from operating in US, as well as implementing certain restriction on China access to US technology. So it has become a competing war between two of the world's biggest economies to on US side to pretend to prevent China from reaching a similar hegemony status like the US, and also to restrict China growth so that it will always play second fiddle to the US. Then we also have the financial instability in emerging market as the US dollar strengthens. Now this will impact countries which have high US dollar denominated debts. And we already see it in China, okay, where later on I'll touch on why China is facing a wave of banks which actually have not announced their 2018 financial results, okay? Mainly because of a lot of illiquidity in their balance sheet. So it's also affecting India as well, okay, where India has seen its currency drop and therefore increase the burden of debt payment. Even in Malaysia, we also see that when we borrow money from the US, in terms of US dollars, just about a decade ago, you know, it is around 3 point something. Then it shot up to 4 point something. And then that will increase the burden of debt payment. So what happened is a lot of countries in the emerging markets, they borrow a lot of US denominated debt. And because of the strength of the US dollar, right now they find that they have a lot of difficulties in meeting some of the debt repayment. And of course, I think everyone is familiar what happened with Argentina, which actually is in default. So the recent report madness by the Fed indicates that financial instability has extended to the developed market. Now, report is a very big issue, and I think I will not discuss it in detail here, but it is like the banks do not trust each other anymore, so much so that the overnight rate suddenly skyrocketed and the Fed have to step in to actually pump liquidity into the market. Okay, then we also have the fallout from Brexit, which could reverberate across Europe. And we will know how bad the impact is by the end of this month, and how in the subsequent 3 months, we will see how Europe will behave. But Europe is already mired in an economy that is almost near recession. So we also see that the rise of protectionism and nationalism, which will retard global trade. In US, you have Trump implementing tariffs, okay? Then in a lot of countries in Europe, they have a burst of nationalism, and those right-wing parties are once again having a strong foothold in the elections. So, and can actually jeopardize the open market concept that is practiced by the European Union. Then there's also persistent fear and anxiety as geopolitical tension rises across regions, and potentially a policy error by central banks. Now, why do I say it's a policy error? When the global economic crisis, when the global financial crisis happened, we see the Federal Reserve pumping a lot of money into the market, increasing the balance sheet from 800 billion to 4.5 trillion. Subsequently, the Federal Reserve started to have quantity tightening and increase interest rate. And they have not even reached the stage of normalization, which they targeted at 5% interest rate. That's what they want to revert to, 5% interest rate. But as soon as they touch 2.5%, the whole market vomited all the gains, you know, by 20% in late 2018. So what the Fed did, they started easing again, okay, in a sense that they started lowering interest rate. And that's why, you know, the bull market continues. So the bull market is not a function of a strong economy, but a function of cheap credit. So much so that between 2009 until 2019, corporations in US have pumped $4 trillion into the stock market by buying back their own stocks. So that is driving the stock market. It's because of the cheap credit, allowing corporations to borrow money on the cheap to buy back their own shares, so as to lift the share price and allow the corporate executives to exit their share option with a good profit. So in Europe, we have the European debt crisis, and they went into negative interest rate. So if negative interest rate has been very successful, why is it that now in 2020, from 2019 to 2020, a lot of the European banks are finding difficulty to achieve profitability? And on top of that, Europe is once again heading back into recession. So this is all central banks' policy error because they want to secure the confidence in the market by pumping a lot of money into the market, but then it only enrich certain parts of the society. So much so that the income gap, the wealth gap between the haves and the have-nots have widened to one of the largest in history. So that is what the central banks have done in Europe and in US. Then we have the 2020 presidential elections. Now, Trump's second term will extend the trade war between US and China, and possibly new tariffs will be implemented against countries which Trump deems having advantageous position versus the US. Now, already Trump, about 2 months back, he already set his sight on Vietnam, okay, because Vietnam suddenly have a very advantageous position because the factories moved from China into Vietnam, and then Vietnam trade with the US started to increase, and then there's a widening trade imbalance between US and Vietnam. So Trump again has set his sights on Vietnam. And before that, Trump have also mentioned that he will actually have tariffs imposed against his European counterparts. So if Trump wins a second term, then likely I think there'll be continued trade war with China, because so far the phase one deal is really nothing much, okay? China all the while have been buying US agriculture. It's just that when US threatened to impose more tariff, China likewise follows suit. So, but actually the scaling back of the tariff is just 7.5% of the tariffs implemented in the month of September. So the other tariffs that were implemented before September 2019 are very much in place. So what are the key issues that US and China will never see head-to-head? That is the sponsorship of state-owned enterprise. China actually provides support to their state-owned enterprises so that they have a competitive advantage. So US wants China to totally cancel that out, which China will never do, okay, because by submitting to US demand, then the Communist Party would be seen as being weak, and therefore they will not do, and also they will not let America dictate their national economic policy. So that's why I think that if Trump wins a second term, relationship with China will continue to get worse and not better. Okay, as I mentioned, going back to the first point, tech war and ideology war. Now, if let's say a Democratic president is elected, then we will see increased social programs and higher taxes, both of which will be detrimental to the US economy. So all the Democrats are saying that, you know, some of the leaders like Bernie Sanders, Elizabeth Warren, they already stated that they are going to forgive student loan. Now, student loan is to the tune of $1.7 trillion. If they forgive this, which means all the money that is, all this debt will be wiped off. Now, if US decide to wipe off certain large chunk of the debt, then that would actually undermine the US dollar. And then the Democratic president are all for MMT, modern monetary theory, which means giving money directly to the consumer to spend. So either way, I think whoever wins, 2021 will still be a year of turmoil. And 2020, we already have seen the beginning of a lot of geopolitical tension in the Middle East. So let's look at the current GDP trajectory. You can see that US quarterly GDP is trending down. Now, this is supposed to be the greatest economy in history. That's according to Trump now, okay? Trump says this is the greatest economy in the history of the world. You know, he went, you know, from US suddenly it became, you know, world, become, you know, comparing within US, it becomes comparing with the world. Then you look at the Euro area quarterly GDP, you know, it's actually tanking. And then China quarterly GDP over the past 1 year or a little bit more than a year is also trending down. Versus if you look back, you know, the chart all the way to 2009, you know, the GDP then was 10%. Right now it's falling to 6%. And this year alone, the Chinese Communist Party is already expecting sub 6% growth in GDP. And Japan quarterly GDP, you know, is trending down slightly. And Japan is an economy where, you know, it's neither here nor there. They are into their 30th year of deflation. Okay, so Japan is a very unique economy. Okay, ever since the property prices reached their peak in 1989 and stock market reached its peak in 1989, they have not even reached back to that record level yet, you know, after 30 years. So that is why, you know, sometimes when people say that property price can never collapse, okay, in Japan it has already collapsed for 30 years, okay, and stock market has been neither here nor there, okay, have not even, whereas a lot of the other stock markets globally have already reached record high, Japan have not reached their record high achieved in 1989. Now, Japan is a very unique country because they are also facing negative childbirth. You know, for each death recorded in Japan, the childbirth is just 0.86. So that means that, you know, with this kind of scenario, there is going to be more and more elderly people and less younger people. So that is the situation in Japan. Now, let's look at the GDP and how they fare. US GDP fell from 3.1% in Q1 2019 to 2.1% in Q3 2019. Now, this is supposed to be the best economy in the world, but between Q1 and Q3, there's a 32.3% decrease. Then if you look at the Euro area, GDP fell from 0.4% in Q1 2019 to 0.2% in Q3 2019. Now, this is a 50% decrease. China GDP fell from 6.4% in Q1 to 6% in Q3 2019. This is equivalent to a 6.3% decrease. So China is, GDP is not so badly affected, but China has a lot of internal structural problem. Yeah. Japan GDP fell from 2.2% in Q1 to 1.8% in Q3 2019. This is equivalent to a 9.1% decrease. Now, all this seems to be pointing towards GDP are going towards a slowdown. So let's look at global debt. Now, this is the amount of global debt. And the latest, I don't have the latest chart, but this chart was based on Q1 2019, was sourced from the Institute of International Finance. Now, in Q1, total global debt was 246.5 trillion. The chart for Q2 is not out yet, but in Q2 2019, they announced that the total debt is 250 trillion. Now, based on that trajectory, full year 2019, total global debt is expected to reach 255 trillion. And that is where the GDP as debt as a percentage of GDP. You can see that global debt is now more than 320% of global GDP. Now, if you imagine that you own the credit card company 3 times your annual salary, how are you ever going to pay back that credit card debt? Okay, and this is precisely what we are seeing here in the global economy. For each dollar of GDP, it needs a few more dollars of debt to contribute. So when we talk about global GDP growth, does it really mean real economic growth? Not necessarily, because it's all financed by debt, which means it's borrowing from the future to enjoy the economic fruits today. So let's look at total debt to GDP, breaking it down, how much it has grown since then. Now, global GDP in 2018 was 84.8 trillion, and total GDP during the just in the aftermath of the global financial crisis is 60.1 trillion. So global GDP has gained $24.7 trillion. Global debt in 2018 was 243 trillion. And global debt in 2009 was just 109 trillion. Total gain of 134 trillion. So here we can see that between 2009 and 2018, total global GDP gained only 41.1%, but total global debt gained 122.9%. So that means that that growth continues to outpace GDP growth. And this is a bad sign because any economy that is fueled by debt would soon find itself too burdened by interest payment, okay? And also a continuing process which any country would continue to borrow to pay for interest, and meanwhile the interest repayment will continue to spiral out of control. And this is what we are seeing now in a lot of countries. So let's look at the global sectorial indebtedness. You can see that household between 1997, okay, to 2019, household has actually increased by 213%. Okay, and then you see in the last 20 years plus, non-financial corporate has increased by 248%. Government itself has increased 253%, whereas financial corporation have increased 210% in the last 22 years or so. Now, this is a very, very dim picture because it goes to show that government continue to borrow to stimulate the economy, corporate continue to borrow for business expansion, even households are borrowing to make purchases. And that is why a lot of economists are saying that in the near future, the debt can only go up and up. Because once governments, for example, if they borrow to give towards welfare, it will always be very difficult to take it back from the welfare because that would cause a lot of public outcry. So government debt, if they borrow to subsidize the welfare, will just continue to pile up debt. And then non-financial corporate, okay, as long as there's cheap credit, okay, now back in 1997, where corporates are very much more responsible, okay, money is borrowed and is invested in plant, equipment, personnel to improve productivity so that it improves the company competitive edge. But in the aftermath of the financial crisis, okay, you can see that this is 2017 and 2019. Corporate have been borrowing so much just to buy back their own company shares without investing as much in plant, equipment, and personnel. That is why the GDP cannot grow very high because productivity is lacking. Only with productivity growth can the GDP growth be expanded much greater. But with little money put into productivity growth, that's why the GDP is expanding at a very slow pace. Now, this is the problem facing mature markets and emerging markets. You can see that from 1998, mature markets as a percentage of US denominated debt, mature markets, yeah, ex-US, have been increasing. Now, emerging markets used to be more responsible, but after the financial crisis, emerging markets themselves are also borrowing hand over fist, okay, to offset the impact of the crisis. So when they increase their amount of, whether it's mature markets or emerging markets, when they increase the value of dollar-denominated debt, then the increase in the dollar value means that both parties will have to pay more to whether it's interest or to pay back the principal. So This is a chart also from the Institute of International Finance, where it shows the negative outlook among emerging markets and those with positive outlook. You can see that one of the major one is Mexico, Argentina, South Africa, Korea, India. These are with negative outlook. Okay. Then we have Chile, Brazil. Okay, this is Philippines. Philippines is not that bad. Okay. And sorry, this is Indonesia and this is India. Okay, this is Indonesia and this is India. China is not that bad. Okay, but because China has a lot of companies, yeah, so when they do the average, it's a bit of balance. But then China, on the bad side of it, there's a lot of internal problem. Okay, let's look at emerging market debt. So emerging market look vulnerable due to extensive debt denominated in US dollar. This will add to the burden of repayment as the US dollar rises in strength. China faces tremendous difficulty in arresting corporate debt. So China's major debt is not so much as government debt, but corporate debt. So that's why when it average out, it's like, it's not the, whether it's positive and negative outlook is quite balanced. Okay, because China's government debt is less than 60%. Household debt, I think, is hovering around 70 or 80%. Okay, but corporate debt is 250% of a GDP. Now, this is very bad. Okay, this is among the world highest in corporate debt to GDP in terms of percentage. There were 20 banks in China with more than 64 trillion renminbi in assets, which delayed the issue of their 2018 annual report. Now, this is based on a Zero-Hedge article dated 25th August 2019. Now, 3 banks are already illiquid, requiring government's assistance. That means bailing out, okay? Local governments too have excessive debt. Recent policies seem to be directing towards lower consumer debt and restricting short-term debt issued by distressed companies to refinancing and not for business expansion. So China now is reining in the corporate debt. In fact, in 2020, just about a few, I think in December, they announced that by 2020, they are bringing in about 12 top financial and former bankers here, financial expert and former bankers to look at the entire debt situation in China. So I think there's a lot built out, and some of the even some of the state-owned enterprises, the government will allow them to fail. Just to make an example, to so that the others would toe the line. Okay. So India has several bank scandals over the past few years, which have brought public confidence in her banking system. On top of that, Indian banks face credit risk amid low profitability, thus posing a risk. Now, this is from a CNBC article on 10th of April 2019. India risks seeing its GDP falling. In fact, India's GDP right now is pretty stagnant. Okay. And India right now also has its own internal strife, okay, because of the recent ruling on the gaining of citizenship. So other emerging countries at risk include Mexico, Argentina, Brazil, and Turkey. And of course, the last thing we save for the as a shocker, U.S. debt. As of 3rd of January 2019, U.S. total debt stands at $75.3 trillion. Now, this includes all sorts of debt, including government debt, which stands at 23.2 trillion, mortgage debt at 16 trillion, student loan at 1.7 trillion, credit card debt at 1.1 trillion. Now, student loan is already at record high. Okay. Not only that, auto loans in US is also at record high. Now, if we break down further, actually a lot of auto loans in US are actually subprime, which means, people are pushing vehicles to customers. The dealers are pushing the vehicles to customers who do not meet that kind of credit worthiness. Okay. Just so that they want to get the inventory out. And that creates another subprime. You know, in 2008, we have the mortgage, subprime mortgage debacle. And right now we have the auto loan subprime as well. So the financial institutions will never learn, I guess. So another most troubling thing with the US is that unfunded liability stands at 127.5 trillion. Now, unfunded liabilities means that, you know, for example, you know, imagine that the EPF say they have this much amount of money, but this much amount of money is based on the future that the EPF have to pay, but right now they don't have the money. You know, so can you know, but thankfully Malaysia EPF is not like that. Okay, but in US, the Social Security and Medicare, they are unfunded, which means they have no money at all. So every Social Security that is being paid, every Medicare that is being charged out, the US have to borrow money to pay for them. That is why the US debt keep on racking up higher and higher and higher. Because the future liabilities, you know, like Social Security and Medicare is unfunded. You know, it is only funded as and when they need to pay. And that means the US have to borrow from the, by issuing US Treasury. Then you look at the GDP at only 21.7%. Government debt is already more than 100% versus the GDP. And then it's not surprising. Government spending is 4.6 trillion. Government tax revenue is only 3.5 trillion. Therefore, there's a deficit of 1 trillion. So you can imagine that the US, you know, price themselves as the best country in the world, but it's also the most indebted. Okay. So debt per taxpayer is $187,387. Debt per citizen is 70,107, which means a baby that is newly born already owes the US government 70,000 US dollars. So if we look at it, the total debt plus unfunded liabilities, excluding off-balance sheet items. Now, off-balance sheet items are those that they never declare one, okay? There's a lot of those hidden stuff, yeah, okay, in the US financial system, okay? And that by itself, okay, total debt plus unfunded liabilities is 934.6% of GDP. So if you look at it, distressed companies in US, most of them are in the small cap companies. Even the mid cap also have some risk. Okay, large cap, of course, they are much safer. So small cap, you know, I read an article previously that states that about 63%, if I'm not wrong, yeah, 63% of the Russell 2000 companies are unprofitable. Okay, which means that they are facing losses. So that is what is happening, okay, when companies borrow too much but not spend on improving their competitive advantages, but rather buy back their shares and so forth. Okay, every time pushing the EPS higher, or when they are lost, pushing the loss in terms of EPS lower. So that is what we call financial engineering. Now, just as an example, yeah, going back into Q2 2019, Boeing actually, during the height of the 737 MAX crisis, yeah, Boeing balance sheet actually revealed -5 billion in net asset. -5 billion, okay, which means the whole company, you know, they still owe the market 5 billion. And if you look at it, Boeing, from, I think, over the last 10 years, Boeing actually spent $43 billion in buying back their own company stock. And can you imagine that this 43 billion was actually used to improve the 737 MAX so that there's no problem with the aircraft. But instead, the corporate executives decide to enrich themselves, buy back the shares, push the EPS up, and then they exit the stock, with the Boeing stock. So right now, you know, Boeing is so heavily indebted, the shareholders are left holding the bag. Another company similarly is GE, General Electric. You know, GE used to be in the Dow 230, you know, but after a while their shares keep on dropping and dropping, and then right now is no longer in the Dow 30. And it's supposed to be the surviving original Dow 30 company. Okay, just a few years back before they were taken out of the Dow. So that's what's happening. You know, or you might say that Apple, you know, Apple now is the world, you know, richest company, okay, in terms of valuation. Do you know that Apple sales throughout 2019 actually increased 2%, but its stock actually increased 84%. You know, its profit only increased 2%, but then its stock increased 84%. Why? Because Apple borrow a lot of money to pay dividend and buy back its own share. Apple actually has a lot of a huge cash hoard somewhere, but they do not want to bring all of it back in because of the taxation. So rather they keep offshore, but then in US, they actually borrow money. So can you imagine that Apple is only 2% increase in profit, but then its share is 84%. So that's the correlation is totally out of, out of sync in a way. So what are central banks doing? You can see that here are two charts in August 2020, when the this New York Fed actually have a predictive model, okay, for coming recession. Okay, now in August 2020, the percentage of a potential recession in August 2020 is 37.9%. Okay, when they forecast in August 2019. So this is a 12-month running prediction of recession. So in November 2019, they predict the next 12 months having a recession. It dropped 24.61%. Why? Because the Fed is manipulating the market. Okay. So you can see that when the inverted yield happen, okay, the risk of economy spike up. So what the Fed did, they pumped back a lot of liquidity into the market. Okay, they started to ease, and then the risk was lowered because apparently everyone likes when the Federal Reserve reduce interest rate, because lower interest rate means that company can borrow money, okay, for economic expansion. Actually is not so. They borrow money to buy back their own shares. So that's why corporates are so happy. Okay, so central banks have been easing to prop up global debt and stock market, as the heavily indebted market cannot afford a rise in interest rate. Because as we say, what the Fed wanted to do was normalize interest rate at 5%, but at 2.5%, the whole market puke. So that's why we will never go back to normalization, and interest rate will continue to trend lower and lower where the US is concerned. So the demand for US dollar to pay off US denominated debt is one of the reasons why there is a shortage of US dollar liquidity. Because as I mentioned, emerging markets, they have pressure, okay, to pay off their US denominated debt. So the Fed is intervening in the market to force short-term interest rate lower and the long-term interest rate higher in an attempt to reverse the inverted yield between the 3-month and 10-year bond, which normally heralds a recession. So this is how the Fed want to manipulate the market, okay? By right, central banks, especially the US Federal Reserve, their job is to look at steady price, okay, in terms of consumer, in terms of inflation and so, but suddenly they become market manipulators already, okay? Just because if the US sentiment on the US economy falls, then there will be a huge debt implosion. So right now what they do, they are propping up the debt-infused economy with even more debt. So it's like, the Federal Reserve is building a house of cards, higher and higher and higher, and it just takes a little bit of wind to knock the whole thing down because it's all infused with that. So why I say the Federal Reserve is supporting the market, you can see that this is the expectation of the S&P earnings. Now the S&P earnings have already gone into negative, but you look at the S&P index. This is ridiculous because the market totally now does not believe in fundamentals anymore. It's being chased by algorithms that scan every headline, okay, just to push the market higher. But you can see that earnings expectation in the S&P is already in negative territory. This, you can see how the Fed report, recent report affected the market. This is change in the Fed balance sheet. This is the change in the S&P. You can see that the Fed pumped liquidity, then the S&P went up even higher. So the Fed recent report and QE actions, I say QE, even though the Fed say it's not QE, but as long as the Federal Reserve is monetizing short-term debt, that itself is a QE action already. So they are sending the wrong signal to investors as it encourages extreme risk-taking, just as earning expectations continue to languish in negative territory. The Fed report and QE actions are expected to last until April or May, which may suggest Dow at 30,000. Could be a remote possibility, but after that, a major correction will ensue as the Fed support is withdrawn. So what will we see in the month of April or May would determine where the index would go next. I have my belief that the Fed will just continue to print and print and print and print. And we may see Dow breaching 30,000 even, but the US dollar value will continue to drop. So in such a scenario, okay, the value of the Dow in gold would actually, the relation between the Dow and gold would actually be, even the Dow is moving higher, gold could also be moving higher because of the cheap US dollar. So, but much depends on what will happen in the coming weeks between US and Iran. If everything goes back to normal and the Fed continue to print money, then yes, the Dow would continue to move up, most likely. And then up to April or May, we see what the Fed will do. Because the Federal Reserve in their FOMC meeting have already said that after the Q2, they are not going to do anything else. Now, because the market run up has been driven by so much liquidity, if the Fed start to taper again, which means all the short-term QE, eventually is rolled off, then liquidity from the market would also be taken out. Then we will see whether the market would drop or not. So April and May would be very crucial. If the Fed continue to print money, then expect that the market will continue to move up, and gold would also continue to move up because of cheaper dollar. But if let's say things with US and Iran turns sour and we can be seeing a much greater conflict in the Middle East, then we will see that the Dow and S&P, NASDAQ all would fall quite drastically. Why? Because of Iran having threatened that they would actually, what Iran once said, the government once said, if Iran is not allowed to trade in oil, then no country in the Middle East will be able to trade in oil. And I will explain afterwards. So you can see that this is the S&P profit level. And the last time they were at this high in profitability was towards late 2014. You can see that since 2014, none of the S&P, the average profit have reached back to the 2014 level, but then the stock market continued to go up higher. Now, this is reminiscent of what happened in the dot-com. So, dot-com bubble, yeah, it will just go trend higher. After a while, when earnings continue to deteriorate, the market will face a massive sell-off. So, sometimes when we look at it, are we wishing that the market will just continue to go up and up and up? Yes, you know, everyone's wish is that. But there will come a time where people will realize that the valuation is totally out of sync, and that is when a major correction will happen. That is why, if you look at it, between Dow now at let's say 28,000, let's say it achieved 30,000, you know, that's less than 10%. So is that 10% worth for you to chase that index rather than looking at other types of investment that, you know, you can hedge against? So more of this, I think Shane can share with you later towards the end. So implications of Fed support of the market. Price discovery is diminished as investors continually expect the Fed to bail out the market in times of need. Now, this is already inbuilt into the investor psychology. The Federal Reserve has their backs, and that's why, you know, they keep on speculating. And there will come a time, okay, where the Federal Reserve, as long as they keep financing the stock market, what will happen? US debt will continue to increase because the debt, the Federal Reserve have to monetize the debt to feed the market. So what happens is that US debt will continue to increase, and the higher the US debt increase, the more countries would tell themselves, hey, let's not buy the US Treasury anymore. Because if hyperinflation hit the US, then whatever coupon rate we earn will be wiped off. So that's why eventually the Fed will keep on monetizing the debt. And that's when, you know, the music will eventually stop. And already certain prominent people are suggesting that the US dollar is not worth its place as a reserve currency. And who is that person who told, who dared to speak so? It's none other than Mike Carney, you know, the ex-Bank of England governor. In the Jackson Hole meeting, he suggested that the time for the US dollar as a reserve currency is limited. Okay, so that is definitely going to have a lot of impact on the US dollar if the Fed continue to monetize that. So the Fed actions encourage risk-taking and punishes saving. So retirees who rely on interest rate to save because they are already so old. You want an 80-year-old to take a risk in the market again? What if you know, his whole asset got wiped up? You know, how is he going to keep on staying for the next 10 or 15 years? So that's why, you know, it's punishing the savers. The record highs in the stock market indices are not a reflection of improved fundamentals, but the behavior of a dysfunction market. Because as I shared with you just now, S&P earnings is in negative territory, yet the stock market continues to move higher. As the market crashes higher, its vulnerability is multiplied manifolds, and any hints of a pending crisis could result in a major sell-off. So let's see what will happen in this coming weeks. Okay, if the stock market continues to trend lower and lower, I can assure you the Fed will say we will cut interest rate. In fact, some of the economists are predicting by end of this year, US interest rate will go into negative territory. So the Fed action serves only to add to the inflationary pressure, which will result in the US dollar losing its purchasing power further. The magnitude of the Fed's intervention seems to suggest that a bank or several banks could be having some liquidity problems. So otherwise, the Fed would not intervene and inject so much liquidity through their repo action. And it goes to show that somewhere, someplace, a bank or a major bank is in trouble. Now I can just briefly touch on this. Okay, the number one prime suspect is Deutsche Bank. Okay, their total financial derivatives is 15 times Germany's GDP. And because Deutsche Bank is interconnected to the network of national banks, international banks, called the GSIB, okay? Globally systematically important banks, GSIB, they call it. They are all interconnected, and that includes the big six: Goldman Sachs, JP Morgan, Citibank, Morgan Stanley, Bank of America, and Wells Fargo. These six major banks in US combined have financial derivatives that is 11 times US GDP. So if they are connected, okay, one bank's fail, okay, it will reverberate across other banks. So that is what I think has the Federal Reserve panic, keep on pumping liquidity into the market, because somewhere, someplace, a bank is in trouble. Market disruptive forces, okay, auto industry and freight industry recession have been ongoing for several quarters. The auto industry has a wide-ranging impact on manufacturing, because not only do they affect the auto vehicles that is sold per se, but then it involves all the parts, components, okay, across a wider industry. So if the auto industry, is facing recession, then it will impact much greater across the broader US economy. Now, the other thing is that leveraged loans and high yield bonds are proving to be the canary in the gold mine, which means that in a coal mine that is all black, suddenly there's a canary that is yellow in color. That is telling you that, this is the major problem. As earnings fall below expectations and distressed companies have run out of refinancing options, IMF has continually warned of the immense amount of leveraged loan in the market. So what are leveraged loans? Leveraged loans are those loans that are given to non-credit worthiness company. But why do banks do that? Number one, if they loan to these companies, they can charge a very high interest. And then the risk of this leveraged loan is then broken up into small little packages, bundled with other securities, and then sold as collateral loan obligations. Does it ring any bell? Similarly to collateral debt obligations that caused the implosion of the housing market in the US. So CLO and CDO is just the same thing in a different alphabetical soup. So IMF is already warning. And some of these banks, they are saddled with these leveraged loans because when they break it into CLOs, there will lesser demand in the market. Somehow people think that, oh no, we should not buy these CLOs, because they are reminded of what happens to the CDO. So banks themselves are saddled with these leveraged loans, and that is another problem. Another thing, more than 50% of investment grade bonds are rated BBB. Now that is one rating above junk. Investment grade are supposed to be those companies in the Dow, in the S&P. Ford company bonds are rated junk, because they are overladen with debt. So can you imagine 50% of investment grade bonds are rated BBB? Rating agencies have not re-rate many companies which have taken enormous amount of debt for fear of stroking a bond crisis. So again, we are back to 2008, where rating agencies are paid to rate all the CDO AAA because their clients are Goldman Sachs, JP Morgan, and so forth. So right now, rating agencies, they are paid by companies to rate their bonds, but they do not rate the companies even lower, as the company churn out even more debt, because they say then that would cause a bond crisis. So even the rating agencies are not honest with themselves. Okay. And we are going to see a repeat of what happened in 2008, sooner or later, because we are repeating the same mistakes as before. And when that happened, 2008 will be like a walk it's like having a picnic in the park, because global debt then was much lower. Since then, global debt is already 100% higher than that. So that is why, things might look rosy, is because it's propped up by the central banks, by credit easing. If we go back to the fundamentals, everything does not look as rosy. Now, even the Bank of International, this is settlement, okay? Bank of International Settlement recently warned that the Fed is facing multiple LTCMs. Now, LTCMs is often referred to as a major event involving long-term capital management, a major hedge fund which caused the collapse of the stock market in 1989. Now, even the Bank of International Settlement is saying that the Federal Reserve is facing multiple LTCMs. And that has a lot to do with a lot of hedge funds that over-leverage, and then they need money, they need liquidity, they want to put up their treasury as collateral, but banks do not want to lend them money unless the overnight rate, the repo rate is much higher. So that's why there was a time the repo rate spiked to 10% when the Fed funds rate was only about 2%. So not only are we seeing banks now having some difficulties in liquidity, but hedge funds, okay? Hedge funds normally leverage up their cash, like 20 billion, they can leverage up to 200 billion, and then they invest in multiple types of securities. So that's why, Financial Times actually came up with 3 hedge funds which are over leveraged. So it remains to be seen, okay? Again, back to April, August, whether there'll be continuing repo or not. So negative yielding bonds. So suppose you bought a 10-year bond, which the par value is $100 at the price of $120. The bond pays a coupon rate of 1% per annum. Over a 10-year period, your total coupon payment is US $10. Okay? The redemption value of the bond is at par value of $100. So total return from your investment at the end of the 10-year is 110, but you paid 120 for the bond. So your investment cost you a loss of $10. So the bond is negative yielding, resulting in a loss upon maturity, even though it pays a coupon rate. And when we talk about negative yielding bond, we have not even talked about inflation, which runs at 2%. So if, let's say, okay, annually is 2%, over 10 years is 20%, let's say, okay, then your loss becomes 30 because you cost in another $20 of inflationary impact, okay? So then the loss is 30. So that's why negative yielding bond, why is there a negative yielding bond? Because when everything goes south, like what happened in 2018, everyone wants to buy treasury, government bonds, and so forth, even though that the yield is very low. And then as they push the bond price higher, then the yield becomes negative. And they keep on doing it because somehow investors believe they can pass the ball to someone who is another fool, so that that person willing to pay even a higher price to hold the bond because of fear of the risk in the market. But negative bond, if you are a bond investor, is something that you should never touch, because if you hold on to the bond, eventually you earn a negative yield, and with inflation, your loss is going to be much higher. And not only that, once the bond price, keep on going high, and then there's a sell-off, that bond could lose 50% of its value, and then you'll be burnt. Okay. So 10-year government bonds, as an example, Switzerland, okay, is negative 0.5%, Germany negative 0.23%, Denmark negative 3.4%, Netherlands negative 1.2%, Austria negative 0.04%, Finland negative 0.13%. So the number of 10-year government bonds with negative yield has dropped, okay, because when the stock market is good, people exit from safe haven assets to invest in securities. So what happens is when you sell bond, the yield will actually spike because they are inverse of each other. So recent update put the total amount of negative yielding bonds at 11.4 trillion in November versus 17 trillion in August. Meanwhile, Reuters reported on 3rd of December 2019 that total European bonds with negative yield has fallen to 57% in November, down from 62% in October, based on the total market value of 8 trillion. The amount of negative yielding bonds may spike again should risk return to the market. So right now, we are seeing that this Iran-US thing, bond yields are already dropping across the board, okay? So global trade and PMIs. I'll take a sip of water first. So global trade is forecast to fall below the average from 2000 and between 2000 to 2018. Now this is the average over the last 18 years. Now this data is from WTO. Okay, sorry, this is the, average trade growth is this, and average GDP growth is this. So average trade growth is this line, but you see that since 2018 and 2019 and forecast 2020, average global trade growth is actually below the average of the last 18 years. So this is the global merchandise trade in the last quarter, which has fallen behind the same period last year. This is what is pushing the global manufacturing PMI lower. You see, it's already in negative territory. So global composite indexes, purchasing manager indexes, global, you can see that is going on a downtrend. Composite means it includes the manufacturing and non-manufacturing. Okay, although it is in expansion, but the value is low. If you compare it versus just about 2 years ago, okay, it is above 54. Right now is at 51 plus, and here just slightly above 50. Then if you look at the global manufacturing PMI, you can see that advanced economies is in negative. And that is mainly from the European countries. Yeah, emerging economies are pushing it up, okay, so that the global index is just slightly above 50. But generally, it's still on a downward trend. So whether this uptrend would go up or come down again remains to be seen over the next few months. Now this is the non-manufacturing, which is the services industry. Okay, again, emerging markets are leading, okay, with advanced economy and the global index just ticking slightly up. So look at the trade war and tech war. Goods and services, trade deficit of the US. So this is the 3-month moving average, and this is the monthly deficit. Okay, it has, even as the US is imposing so much tariffs, you can see that it's not pushing the US trade deficit much lower. Okay, it's still in deficit. Now, of course, why is that? Here there's a trend that it seems to be going down. Okay, will it actually shoot back up? Now, even as it is going down, what the tariff has done is that it has impact the whole global economy, and how that the trade deficit can be down. Now, for example, if tariffs goes up in the US, people would actually import less because it's more expensive. So that is why if the US import less but it's export because some of US export, for example, like technology is still growing, okay, therefore the trade deficit can actually reduce slightly. But what if the global economy sentiment is actually very low, and therefore export is also low, import is also low? Then you also have a very much lower trade deficit. So sometimes the trade deficit, while it is an important gauge, sometimes when we look into the GDP, may not be telling the whole story. You know, that US is successfully reducing its trade deficit. It could be an indication that global economy is much worse, that both import and export is being affected. Therefore, there's a lower deficit. So US trade deficit with China. US trade deficit with China from January to October 2019 was $294 billion versus $344 billion in 2018. Now, the tariff has resulted in lesser import from China, but have done little to address US trade deficit as imports have only shifted to other countries ex-China. You know, for example, like Vietnam, Indonesia, and Africa. Now, a lot of people are saying that the tariff, you know, is causing an influx of companies to leave China. It could be true, but I'll share with you something. Now, one of the thing that I come across very often is that Chinese companies themselves are moving out of China, not foreign companies, yeah, but Chinese companies themselves are moving out of China because China now is moving up the value chain in terms of industry. They are moving up the value chain. So when you are moving up the value chain, the wages of the workers also would increase. So what China is doing is that they are relocating their factories to Vietnam, to Indonesia, and to Africa. For example, those that are very labor intensive, that require sewing, apparels, shoes, hats, all this, they're moving out. But then the sewing is only done in that country. The material, okay, for example, shoes, the fabric, the sole, the lasers, they're still importing from China. The yarn, the buttons, the zippers, they're still importing from China. But only when it is sold in Indonesia, then it's exported to the US, there's no tariff. And that is how some Chinese companies are bypassing the tariff, okay? Because the basic materials are still imported from China because it's still cheap. That's in Indonesia, once they've assembled, they've sewn the whole apparel, then it's sold to the US, there's no tariff. So that is how some companies in China are actually moving out. But a lot of the basic materials are still coming from China. So whether it's effective or not, I don't think so. Okay, with regards to the US tariff, as impacting China's trade and so forth, because China trade with the US reduced, but the trade with the other parts of the world increases. So why trade deficit with China? Now, US corporations have offshore US manufacturing over the last few decades to China. US also consumes more than she produces, hence the reliance on imports. Because when manufacturing in the US have moved externally, what US does is just only consume. She produces less. So when you produce less, the reliance on imports is bigger, and therefore it actually expands the trade deficit. China can readily produce many products herself, hence less reliant on imports. Now, US does not allow China to purchase technology products deemed a threat to US national security, whether it's economic or military-wise. So, for example, China has a thirst for US technology, but right now, US has already banned Huawei from getting, or rather have restricted Huawei in her accessibility of US technology, but meanwhile have banned other Chinese companies from getting US technology as well. So the one thing that the US has that China wants, they are restricting the availability to get that technology. So that's why that trade deficit forever will be there, because US is a technology powerhouse. She can actually, if US allows China to buy, then that trade deficit will be narrow. But then of course the US argument is that, hey, we sell it to China, China reverse engineering, then they come up with something better. So maybe that's why they do not want to sell. Okay. So as I say, the trade war is just a ruse. Originally, the trade war has everything to do with the trade deficit. However, reports by the National Security Agency and Pentagon in 2018 have identified China as the greatest threat to US hegemony and a challenge to US dominance in the world. So to the US, their dominance in the world is the singular most important thing in their minds. There can be no one they can share the world with as a peer. They must be the dominant power in the world. And that is why, we see the world as it is right now. US has 980 military bases located all over the world. And if you look at the map of Russia and China and the surrounding US military bases, you will understand why China and Russia are, they are working together earnestly, because to counterbalance US threat. So the trade war eventually morphed into the following: curbing China's rapid advancement in technology and military expansion, stalling the Belt and Road Initiative, which could form the world's largest trading bloc. That is why you see a lot of negative news about being a debt colonization and so forth. Now, whether it's debt colonization or not, China is not the only one doing it. US is as well. US also have its own debt colonization through the IMF and World Bank, because US is the largest sponsor for IMF and World Bank. It is IMF and the ECB that made Greece bankrupt. It was the IMF and World Bank that made Argentina bankrupt. So it's like the pot calling the kettle black. Okay. So US saying that China, is colonizing countries through that doesn't put US on a pedestal that is much higher than China. It's the same pot calling the kettle black, because through the IMF and World Bank, a lot of countries have been impoverished as well. If you go back to 1997 Asia financial crisis, all the Western nations are urging Southeast Asian countries to load up with IMF debt. So much so that most of them took about 10 to 15 years to eventually pay off all the debt. So, as far as I'm concerned, one saying the other one, okay, being a debt colonization doesn't make the other person, on a higher pedestal, okay? Then the other thing is to delay China's progress in Made in China 2025. Perhaps China's mistake was due to their upbeat feeling and sentiment and belief that they are heading towards that dream, that China announced that by 2025, they would want to have 70% reliance on homegrown technology. Now that actually irked the US government, and that is why the trade negotiation morphed into a lot of things to do with IP, okay, and also restricting China access to technology, because all this aim is to delay China progress in Made in China 2025. And the other thing is preventing China from achieving global dominance in trade and achieving her African ambitions. So a bit on the phase one deal. Now, phase one of the trade deal is essentially a nothing burger. Okay, that's what I believe. US agrees to roll back partially September tariff by 50%, effecting an increase of just 7.5% plus existing tariffs of 10%. China agrees to purchase 40 to 50 billion of agriculture product from the US, but this itself contravenes China's recent purchase agreements with Russia, Argentina, and Brazil. China even went as far as developing infrastructure needed to transport agriculture product from Argentina's deep interior. Now, it is doubtful that China can fulfill a pledge to the US. Now, all this is what I know, okay, but why China is willing to meet US demand for 40 to 50 billion if let's say China cannot meet? Now, there are a few things which comes to my mind. Number one, China is just playing ball, okay, because China has a debt problem and she needs her economy to grow so that the debt can be reduced for a lot of the companies, rather than because of tariff companies, some of the countries could be in danger of collapsing. So China, try to pacify the US because that 40 to 50 is in a 2 years time. So China by itself 2 years time, okay? And the other thing is China expect US dollar to fall even greater so that 40 and 50 billion worth doesn't come with the same amount of quantity at the present versus the future. So if US dollar falls in the future, then that amount in terms of quantity will be lesser. And the other thing is that China is seeing global risk across the world and perhaps a potential conflict with Taiwan that will involve the US and therefore a need to stockpile. Now, I will touch a bit on the Taiwan thing later on in the geopolitics session. So these are the three things that comes to my mind why China agrees to 40 to 50 billion. Okay, of course, everything being normal, I think China would likely want to extend the deadline for her to settle other problems first. So while playing for time, okay. So China also pledges to stop currency manipulation, instills IP protection, and opens up her financial sector. But this is nothing new because China has already announced the latter two in several economic forums over the past year. So it's really nothing new in this regard. Okay. Most importantly, existing tariffs against China still remains, while China only rolls back selected tariffs against the US. Phase 2 will be the toughest to reach an agreement as it touches on China's sovereignty to decide her own economic policies. Meanwhile, US is widely expected to curb future Chinese tech listing in the US to prevent them from accessing funding through the US stock market. And there were some talks that to some extent that US, during the height of the trade war, US even suggested that they may want to prevent China from accessing the SWIFT system. So that's why when US, they talk in this manner, China is actually, it will actually push China to prepare more concrete plans for the medium to long term. So from trade war to tech war. Now, even as the phase 1 deal is near conclusion, the tech war has just started. US has banned a number of Chinese tech companies from operating in the US, Huawei, for example, or imposed restriction on their business in the US. DJI, which is famous for their drones. And right now, US has disallowed security agencies, the army, and government agencies from purchasing DJI drones. Even though DJI, I think they have a 70% market share, yeah, and access to US technology, or ban them outright from accessing US technology such as Hikvision Digital Tech. Now, US and China are both racing to develop cutting-edge tech such as AI, quantum computing, robotics, and genetics, among others, to lead the new industrial revolution. All these require big data and massive cloud computing, which China, due to a huge population, has the advantage. Okay, because when it comes to AI, it's often, allowing the AI to learn. Now, the greater the data, the better it will learn. And China actually have such a huge population, so the data streaming will be huge. Okay. The US felt threatened by the prospect that by 2030, China will be the world's largest economy and by 2035 will outspend the US in military. Hindering China's rise in technology will frustrate China in forging ahead in the next frontier economy, which is space. So that is what you know, that is what the US is worried about. If China technology really progresses, then US would lose out in the next frontier economy. And then you have Trump, since last year saying that we now need a space force. So this space force now becomes, I think, the fourth or fifth branch of the military. And some people are questioning, why do you want to have a new space force? You just extend the Air Force responsibility. So with a new space force, you need a whole new structure, whole new organization, accountants, auditors, purchasers, and all the admin themselves, is replicating what other agencies are doing. So you can see that, it's actually waste of money. But US is really very afraid because in a very short span of time, okay, China has sent a lunar probe on the far side of the moon. Not only that, in the early 20s, the International Space Station was forbidden to invite China to participate in their programs by the US. But what China did, they built their own space station. So the thing is, this actually worried US because the next thing that they want is China able to bridge the US in terms of moving ahead in their expanding their reach in the outer space, okay, or within the solar system. And just to share with you, in the desert in Xinjiang, China is actually doing precisely that. They actually have a complete model, and the people, scientists that they are trained to live in the desert, similar like those, like the environment in Mars. Okay, so already China is setting her sight to have a colony in Mars. Okay, and that is what all the big nations are rushing. Okay, who will set up the first colony in the moon? Who will set up a first colony in Mars? Because once the Earth, is being excavated, nothing is left. Okay, then we will actually destroy the moon by harvesting the resources there. Okay, so this is the human nature. Now, what is China's response? China has announced that all government agencies must work towards 100% compliance in using local tech, both hardware and software. So no longer, I think they were given 2 to 3 years. And by the end of that timeline, none of the Chinese government agencies should have Microsoft Windows. Okay, Huawei has effectively moved away from having any US parts in their latest devices, developing our own semiconductor industry from scratch. To achieve this, China has set aside tens of billions of dollars to develop this very important industry and has drawn talents from Taiwan. The Asian Nikkei reported on 3rd of December that as many as 3,000 Taiwanese chip engineers have left for China to join the semiconductor industry there. Okay, this is what China is doing, attracting talents, and China is actually willing to pay a lot. I read that it was about 2 to 3 times more than they earn in Taiwan. So China is preparing her own blacklist, which is similar to the US entity list, in preparation that should the trade war worsen, China will also ban certain US companies. Now, as tension between US and China mounts, China has been gradually reducing her holding of US treasuries. From being the top holder, Chinese now lags behind Japan, which has become the primary holder of US treasuries. So China's mind is that, why should I finance a country that is increasingly being a threat to her own security? Okay, you can see here the decline in China US treasury holdings in red. Okay, as tension with US mounts, the incentive to hold US treasury diminishes. Okay, again, it's trending down. So last time it came down, but then China bought back some, but then it's trending down again. So tech war opportunities. Now, US investment opportunities for the following: major tech companies which are developing US 5G network, okay, chip makers which will form the backbone of AI, quantum computing, and self-learning robotics, companies engaged in developing cloud-based solutions with big data, Internet of Things, and AI. So this, for me, US investment opportunities would be, going along this line. China investment opportunities will be existing semiconductor manufacturers will have opportunity to scale up their operations. Local hardware manufacturers and software providers, which will be beneficiaries of China's 100% local content for government agencies. Tech companies already engaging in AI development, quantum computing, and self-learning robotics. Companies engaged in developing cloud-based solutions with big data, Internet of Things, and AI. So you can see that it almost is a mirror, except that, China opportunity arise, for those companies that will meet 100% compliance and semiconductor manufacturers. So geopolitics and oil. These are my areas of geopolitical concerns, which is Venezuela, Syria, Iran, Yemen, North Korea, South China Sea, and Taiwan, Mediterranean Sea. Now, more often than not, geopolitical concerns are often related to oil or trade route. Now, Venezuela. US continues to pursue regime change in Venezuela, including recognizing a non-elected person as Venezuela's president. Now, why is Venezuela so important to the US? US is one of the world's largest oil producers, but US crude oil is very light, and many refineries are not equipped to refine light crude oil. In order to refine, they need to blend with heavy oil. Now, this is the Venezuela basin, okay? Venezuela is sitting on the world's largest heavy oil basin, which the US so desperately needs. On top of that, many US shale oil companies are facing production challenges as previously productive basins are becoming less productive. Shale oil companies too face financial distress due to the low oil price and heavy borrowings. Now, in fact, I think a lot of shale oil companies, they have already started imploding, in fact, between 2020 and 2023, there are easily several hundred billions of dollars in debt that shale oil companies must repay. So, an interesting article, shale oil by oilprice.com, they call it snake oil. Okay, these are the number of bankruptcy filings all through the years. Now, this was when in the first quarter of 2016, oil actually fell down to about 26 US dollar per barrel. Okay, so you can see that bankruptcy actually rise, and right now they are rising again. Okay, you can see that US high yield energy default rate. Okay, it spiked up when oil price dropped to 20s. Now it's spiking up again. Okay, after some lull over here, it's moving up again. Now, according to oilandgas.com, in an article published 29 May 2019, just 10% of shale oil companies in US are cash flow positive. So, and the worst thing is, even when they are cash flow negative here, they continue to borrow money and then they buy back their own shares. That is US corporations to some of you all. Now, in terms of Syria, although Syria government has reclaimed much of its land, portions of Syria still remain in foreign hands. Syria is constantly under attacks from Israel along her northern border. While along her northern border, Syrian and Turkish forces are facing off. Syria wants Turkey forces to withdraw from a territory, but Turkey is adamant to keep them there. Now, this is because the Kurds who are settled in the north are in constant conflict with the Turks. US forces recently seized Syrian oil fields. Now, Syria remains highly volatile area, and future conflicts could break that could break the respite that Assad now enjoys. To make matters worse, the presence of Iranian forces in Syria increases the risk of further attacks by Israel, who sees Iran as a major security threat. Then throw in Russia, whose influence is spreading across the region in challenge to the US hegemony. Syria is of interest to multiple parties because any oil pipeline that goes to Europe has to pass through Syria. So again, you see that whatever conflict, has to do with oil. Iran. Now, Iran has the world's second largest gas reserves and the fourth largest oil reserves. Iran is seen to be competing with Saudi Arabia to expand her sphere of influence in the Middle East. Israel views Iran as a major threat due to her support for the Hezbollah in Lebanon. Saudi Arabia too views Iran as a threat due to her support for the Houthi rebels in Yemen. Saudi Arabia has recently indicated that they will be embarking on uranium enrichment. So, Saudi Arabia is telling, since the Iranians are doing it, we might as well do it, ourselves, to counteract, the threat from Iran. Now, both Russia and China is seen as Iran allies. Iran has an observer status in the SCO. I think to many of you might not have heard of the Shanghai Cooperation Organization, but it is an organization that has very few members, and the cooperation includes three major areas. In terms of economy, which also include financial, and then there's cultural, and the last thing, militarily. Okay, so it seems to imply that, as a bloc, you will see that there's constant military interaction. Okay, like what happened quite recently. Iran, Russia, and China have their joint navy exercise in the Strait of Hormuz. And then about a few months back, China and Russia actually have the largest military exercise seen by the Western nations. So Russia has military interest in Iran, while China investment interest. Iran is an important land bridge in the BRI. China recently signed, now for those who are unaware what is the BRI, is the Belt and Road Initiative. China recently signed a deal with Iran to buy $400 billion of oil in return for $80 billion of investment in Iran oil industry, which include providing Navy escort for her tankers and stationing 5,000 troops in Iran's facilities. So you can see that it becomes a challenge where if US decide to attack Iran. And Iran has now the air defense system, which they bought from Russia, the S-400, if I'm not wrong, said to be one of the best in the world, better than the US Patriot system and the THAAD system. So, but the involvement of Chinese military in Iran's facilities seems to be a strategic move, because should US attack Iran facilities, oil facilities, then it's like indirectly attacking the Chinese military which are stationed there as well. So it becomes a very big issue should war breaks out between US and Iran, because then it will involve, on the US side, Israel, Saudi Arabia, and US versus Russia, China, and Iran. So it becomes a hotbed. Okay, so will that involvement of three major superpowers there, erupt into another kind of conflict elsewhere? That is why, what is happening right now in the Middle East is rather worrying. So US has mounted sanctions against Iran, and Iran hawks in DC are determined to work towards regime change. And like recently, what Trump said is rather mind-boggling to me, because he said, we killed the top commander to stop a war, but it seems like, everyone now is saying war is looming. So how can you stop a war if, let's say, you can't, suddenly everyone is retaliating? So it's just an excuse for the US to prove a point, okay? So on 4th of December 2019, the Wall Street Journal reported that US is considering moving an additional 14,000 troops to the Middle East on top of the 3,000 troops already stationed in Saudi Arabia. And after this Iran incident, I think they are they are immediately sending 3,500 troops to the Middle East. Meanwhile, the Lincoln Carrier Strike Group is just several hundred kilometers off the Iran's south coast. Now, this could suggest that US is staging for a potential military confrontation in the Middle East. There is no other reason why US should be sending so many troops there. I believe that hopefully it won't happen, but oftentimes when US have such a huge military staging, it often leads to some known conflict. So a conflict with Iran could unravel the global oil trade because Iran has said that if they can't sell oil to the world, then the world cannot have any oil coming from the Middle East. And this is where Iran holds the trump card. So look out for a major false flag to justify war with Iran. And I think, there has been a lot of false flag last year, especially the attack on Saudi Aramco's facility. US blamed it on Iran, although the Houthi rebels in Yemen say that they were the ones who did it. Okay, and then the tanker where they put the mine on, US blamed it on Iran. Okay, but then it's still not proven yet. So what is important is that this is the Strait of Hormuz, and it is one of the narrowest strait. Okay, and 1/3 of the world's traded oil supplies pass through this strait. Now, some of the analysts have said that should Iran block the Strait of Hormuz, we can immediately expect oil to spike to $150 per barrel. And Goldman Sachs was a bit more concerned, stating that if the oil cannot pass through the Strait of Hormuz, no one would actually dare to trade in the futures of oil, which means that oil will just go up and go up and go up, and that could bring the entire global economy down, and with it a hyperinflation that has never that the world has never witnessed before. So a lot of all this is rather worrying. Okay, and some of you might say that, hey, we are in Malaysia, we won't feel such a big impact. Actually it's not so, because if let's say whatever happens around the world, it will lead back to Malaysia as well. And for our country, if let's say we are a net oil exporter, perhaps it will not be so bad. But if let's say the global economy falls down, then like in whether it's in the during the last financial crisis and the dot-com bubble burst, although it happened in US, Malaysia also see its stock market actually falling down quite drastically as well. So we are connected to the world. We are not a safe haven. Okay, just put it to you frankly. Okay, in terms of Yemen, Yemen has become a protected war between opposing regional powers. On one side, the Saudi coalition consisting of Gulf states, and the other Houthi rebels, which are supported by Iran. However, lately UAE is gradually working towards scaling down its military presence in Yemen as Iran threatens to widen the sphere of conflict. Now, Iran can easily send her missiles to other nations in the Gulf area as well. Okay, and that includes Dubai. Okay, all the glitz and glamour of the major cities. Okay, according to some unconfirmed sources, Saudi Arabia-led war in Yemen is intended to seize the country's oil and gas reserves. Now, interestingly, some of these point to the fact that Aramco actually does not have as much oil reserve as the company stated, and that is why Aramco eventually was listed in Saudi Arabia, because no question asked. When Aramco wanted to list in New York or in London, a lot of the investment bank dare not touch the stock to help it launch the IPO, because everyone was questioning the amount of reserves in Aramco. How come after so many decades, the oil reserves never change? Okay, by right, if the Saudi has been pumping oil all through the decades, there should be a gradually reduced reserves. Okay, so that was why no other stock exchanges wanted to list Aramco. Okay, and that's why it eventually won back in listing in Saudi Arabia. That what some analysts was saying. Okay, now Yemen has huge reserves of oil and gas in Jaf, just south of Saudi Arabia. Yemen rebels have claimed responsibility for the attack on Aramco's facility, though the US Foreign Secretary was quick to point the finger at Iran. The attack has demonstrated that the Houthi rebels have the means to attack deep in Saudi Arabia territory, and any heavy damage to either oil refining or storage facility can trigger wild swings in the price of oil. So North Korea, in fact, when Donald Trump and Kim Jong-un were discussing about a summit and so forth, in my global outlook in 2019, I said that there is not going to be any peace agreement, and proven correct. Okay, so despite 2 summits between US and North Korea, both parties remain far from reaching a peace agreement. North Korea will not denuclearize unless US withdraws the sanction and vice versa. North Korea is said to be planning another long-range missile launch, which could intensify the tension in the region. Why North Korea is important? She acts as an important buffer for China and Russia against the presence of US military in South Korea and Japan. It is widely known that South Korea has a vast amount of rare earth minerals deposit, and all 3 superpowers crave for the prospect of mining them. Look out for more rhetoric between Trump and Kim to return. So South China Sea and Taiwan. Tension between US and China is expected to mount in the South China Sea as US mounts more freedom of navigation exercises. Now, this is what I say that would create more tension here. Senator Ted Cruz from Texas is sponsoring a bill to recognize Taiwan's sovereignty, which could cause sparks to fly if passed by Congress. So it's like saying that, US is saying that, hey, Taiwan, we treat you as another country. Okay, so China is expected to continue to build her navy with the third aircraft carrier now in production and ramping up her missile defense system. Both US and China will likely ramp up military spending, potentially putting the 2 sides on track towards a military conflict. US government and media has taken another Cold War mentality against China. Now, this is the Thucydides trap that geopolitical strategists fear. Now, the Thucydides trap is something which says that when there is an aspiring country to be the next superpower, the current superpower eventually will fight a war with the aspiring power. So that is what geopolitical strategists are so frantic about, because they worry that a war between US and China could actually potentially obliterate the world in a sense, because both have nuclear weapons. So Mediterranean Sea and Turkey. Now, this is a new entry to my list of geopolitical concerns here. Tension has been rising between Turkey and Greece and Cyprus due to the ongoing oil drilling by Turkey in the Mediterranean Sea. Now, to add to the tension, Turkey may not be able to stop influx of refugees into Greece. Turkey is now flexing her muscles not only in the Mediterranean Sea, but also in Libya and Syria, much to Russia's frustration. Meanwhile, US is implementing sanctions against Turkey for buying Russia's S-400 system and forbade Turkey from getting her F-35 fighters, which she is also one of the joint project developers. Making the situation complicated is the presence of US nukes at the Incirlik Air Base. So Turkey is again, a country that is mired in a lot of controversies with her neighbors and other. At first, Russia and Turkey seems to have an agreement, okay, but then Turkey infringed into Syria, which Russia is invited as a protectorate, okay, of Syria, protector of Syria, and despite Turkey shooting down an MiG fighter a few years back, Russia has not, imposed very hard sanctions against Turkey. So, but then Turkey's recent infringement into Libya, okay, also frustrate Russia because Russia is working on a big deal in Libya as well. So, seems to be some tension flaring up, okay, along North Africa, Syria, as well as Southern Europe. Now, signs of monetary reset. So let's talk a bit about the unipolar world. I think many of you might not have heard about what is the unipolar world. Now, it has a lot to do with the emergence of US as the strongest country after World War II. Foreign policy is driven towards a unipolar world where the military plays a vital role to ensure compliance and acceptance of US hegemony. And that is why when Gaddafi proposed the gold dinar for trade within Africa itself, his country was bombed and he was murdered. And just as Saddam Hussein was proposing that all oil trade in Iraq should be done in the euro, his country was invaded. So that is how the US used its military to ensure compliance and acceptance of the US dollar. Established the petrodollar, where Saudi Arabia will sell oil in US dollar in exchange for US military protection. So talk about being a mafia or a secret society. Now we are seeing it at the global stage. Okay, you sell oil in US dollar and I give you my protection. The US dollar will then be recycled back into US treasuries, thus enabling the US to have the financial means to expand her economy and sphere of influence. More than 60% of international trade is conducted in the US dollar, and more than 60% of foreign reserves are held in US dollar. The US dollar is also an effective weapon. US could prevent the accessibility of the US dollar to certain countries in order to hurt these countries economically, such as what's happened to Iran and Venezuela, as some of the examples. However, the US dominance is being challenged. Now, US hegemony explained. Now, when we say that if the US prints so much money, how come their inflation is still not there? Okay. What happened is this, because US dollar is used in global trade 60%, and in foreign reserve, the US dollar is parked outside of the US. And for those people who park the US dollar, okay, they, rather than just holding US dollar, they want to hold US treasury that at least earn them a coupon rate, okay, earn an interest. So that is why the US inflation is kept down. So as a world reserve currency, US is able to continue to rack up debt while exporting her inflation. Now, to offset the unipolar world which the US is imposing on the rest of the world, Russia and China are calling for the existence of a multipolar world to act as a counterweight to US dominance. Multipolar world through the BRICS. Now, the BRICS are the Brazil, Russia, India, China, and South Africa countries. Yeah. In a multipolar world, trade can be done without the US dollar and in local currencies. It will be a world connected via the Belt and Road Initiative, covering land, sea, and air routes. BRICS nation will play an important role in laying the foundation. India is non-committal at the present time, okay, because India is in a bit of a difficult situation because they have a lot of trade with US and also the relationship with Russia and China. So India, because of this kind of, and India is also part of the Indo-Pacific countries that US has roped in, okay, to help monitor the Indian Ocean and the Pacific Ocean, okay, as you know, as a counterweight to China. So India is in that category as well. So as today, India is non-committal. Brazil is pro-US, while South Africa is weak. Currently, only Russia and China are fighting the US sphere of influence. the development of alternate system which allow for bank transactions to be done even if a country is sanctioned against using the SWIFT system. So China and Russia wanted this, okay? Because sooner or later, they feel that a very cornered US in terms of financial clout would start hitting at everyone. And to China and Russia, they might even be barred from the SWIFT system. So that's why China and Russia sees the urgency to come up with an alternate system, okay? China is set to launch her own cryptocurrency in 6 to 12 months time, so that she can trade with any countries outside the prying eyes of the US, because cryptocurrency trade in a blockchain, which is very secure, okay? China can trade with any countries, okay? That cryptocurrency will still be renminbi, okay? It's unbacked it's not backed by anything, but then it allows China to actually use the cryptocurrency to trade with countries that are being sanctioned, establish their own financial infrastructure such as the AIIB, Asia International Investment Bank, to finance the development of the BRI and formation of the new development bank, formerly known as the BRICS Bank, to provide financial services. You can see that already whatever they do is mirroring the IMF and World Bank. So this is already telling you that certain countries are preparing for an eventual break off from the Western control system. Financial stability through gold. See a role for gold in the financial system. Both Russia and China have been aggressively buying physical gold whenever the opportunity prevails. Turkey, India, and Central Asia too have followed suit. So these are the buyers of gold, okay? In fact, all the way back when gold hits a record high during the 1980s, where, in 1971, President Nixon took gold off the gold standard for the US dollar. And since then, the US dollar has been falling in purchasing power. And then gold actually spiked 26 times, okay, from the period 1970 to 1980. And subsequently, the Federal Reserve started to increase interest rate all the way to almost 20% to bring the price of gold down. And ever since then, central banks across Europe and US has been selling gold, forcing the price of gold lower and lower and lower, okay, all the way that they were net sellers in 2000 until 2008. But after the financial crisis, central banks have become net buyers as well. And you can see that it has been steadily growing, okay? And in fact, 2019 will mark the highest that central banks have bought gold, okay, since about over the last decade. In fact, since it was reported since 1965 or 69, the highest that central banks have bought gold. So amount of gold accumulated by China. Now this is China, actually, this is the Shanghai Gold Exchange. Now the Shanghai Gold Exchange is very different from the COMEX or the LBMA, where LBMA actually have futures and OTC, and then COMEX actually sell futures. But this is the Shanghai Gold Exchange only transact in physical gold. You can see that throughout 2008, China has promoted owning gold among her citizens, and to date, 18,000 tons have been withdrawn from the Shanghai Gold Exchange. That means that Chinese themselves, they are buying gold earnestly. And not only that, some people say that the Shanghai Gold Exchange is used to disguise China's own withdrawal of gold as a standby for her reserve. And this standby as a reserve is not reported in the PBOC foreign reserves, okay, but it's already withdrawn and it's owned by the Chinese government. So there are some theories of that, because this is the estimated total of Chinese gold reserves owned by the government. And it is based on the aggregate net import, aggregate domestic mining. Now, for some of you who may be unaware, China is the world's largest gold miner, gold producer. Okay, then you have the official reserve, which sits with the PBOC. Okay, then you have the jewelry base in 1994. So there has been hardly any change, okay, in the jewelry base, but then you can see that aggregate mining has steadily been increasing, and then aggregate net import as well. So a lot of the imports sometimes are underreported because I think Jim Rickards in his interview, he did mention that a lot of people estimate that the amount of gold that goes into China through Hong Kong is often recorded through the ports. But then China and Russia have a close relationship, and so with the Central Asia as well. And Russia and Central Asia have tremendous amount of gold as well in the has a thriving gold industry. So what happens is that a lot of gold is also moving overland into China, which are not recorded through the ports. So hints of a monetary reset. Why do I think so? Now, these are the sequence of events which can shed some light. Now, in July 2014, an interview with the National Press Club, Christine Lagarde, MD of IMF, then hinted of a monetary reset. In October 2016, renminbi was included as a reserve currency by the IMF. In December 2016, the World Bank issued the world's first SDR bond where the settlement currency is in renminbi. In July 2017, Christine Lagarde hinted that the IMF may move its HQ to Beijing in a decade, which means 2027. Does China have a role to play in the scheme of things? Now, what role will gold play in a monetary reset? Central banks in Germany, Poland, Hungary, and Austria have recorded their gold stored in foreign vaults. In April 2019, Basel III rules were implemented. Gold became a Tier 1 asset, which means Tier 1 asset means that you can readily exchange gold at its current price. Previously, it was not a Tier 1 asset, which means you can exchange gold for only 50% of its current price. So that is telling you something that central banks now see the importance of gold. In September 2019, Europe's central banks decided not to continue the CBGA, which is a central bank gold agreement, which is actually an agreement that is based on the controlled selling of gold, which means suppressing the price of gold. So that is already telling you something. A competing monetary system by Russia and China. Now, Russia and China are advocating an alternate monetary system which could center around gold. China intends to launch a renminbi-based cryptocurrency in 6 to 12 months' time. Besides increasing her gold reserves, Russia is said to be allocating some of her reserves into Bitcoin. So Russia is really divesting her reserves, yeah, because Russia has already sold down almost 90% of a US Treasury. Okay, because of all the sanctions, Russia, just like China, is saying, why should I support you financially? You are sanctioning against me. So this diversification from the IMF-based reserve currency seems to suggest that Russia and China are preparing for an event in the horizon which could rattle the confidence in major currencies as global debt global debt becomes unsustainable. The inclusion of renminbi in the IMF basket of currency may be due to the concern that China and Russia may have a competing system through the establishment of the AIIB and NDB, which only serve to undermine IMF and World Bank. So I see it as, IMF was saying that, hey, you're coming out of the system and it's a threat to me. Why not I, put your currency in my basket of reserve? So maybe it's trying to pacify China. We do not know, but this is telling you that a lot of political and financial games are being played among all the biggest countries. US current policies seems to suggest a move towards bilateral trade rather than multilateral trade. Now, this is exploring what a monetary reset can impact on the US economy. Sanctions and tariffs are deemed more harmful as this could push trading blocs to isolate the US and shift away from US hegemony. US has volunteered itself out of the BRI, which will be the next engine of global economic growth. A shift to a multipolar world which encourages trade outside of the US dollar the unwanted US dollar will cause inflation to spike in the US. This could be the strategic move by both Russia and China. Other countries will gain financial and economic freedom from US dollar shackles, and indebted US with rising inflation will sound the death knell on the US economy. The most challenging question is, how will a wounded US react? Now, as the last vestiges of US empire crumbles, there will be an initial global shock. However, by mid-2020s, the BRI would have matured and would fill the void left by the US. Currently, the BRI involves more than 60 countries, which accounts for 65% of the world's population and a third of the global GDP. Only 8 trillion in US dollar in GDP separate between China and US. Based on the projection, China GDP could outpace the US by 2030. India will see her middle class population surpassing the entire US population within the same time frame. So the Africa continent, which is an extension of BRI, will also see tremendous growth fueled by the interconnectivity between cities and heartland to the shore. Eastern Europe and Southeast Asia will also gain from the expanded trade. Several major developed countries will also be participating actively in the BRI. Huge population will be lifted out of poverty, and this will fuel further consumption. Wealth protection and a return to assets with income stream. Now, you need to look at wealth protection because global economic risks have increased due to the following: excessive debt and financial derivatives, trade war or nationalist policies and protections, geopolitical risks, currency wars. As central banks continue to cut deeper to drive even more debt, there will be a point reached where there will be a debt saturation. This is when we will reach a stage of stagflation not seen since the 1970s. Banks have undergone stress tests based on recession scenario and not on a stagflation scenario. Central banks are unprepared for this crisis. As an investor, you need to protect your wealth. Then only can you start to accumulate wealth. Precious metals are the best wealth protection. So this chart was done about a week ago, and it's already showing that gold is on a breakout and could see a emergence of a similar rally between June to August 2019. So productive asset with income stream, you can consider, but then you need to have a strategy to employ, which will correlate with the prevalent risk in the market and economic conditions. But over the long term, when market and conditions improve, should be invaluable assets. So the world is moving towards an economy reset where the balance of power in trade and commerce and perhaps even finance is shifting from the west to the east. Where there's a downturn in sector, there will be an upheaval in another. There is wealth transfer in the making and will provide tremendous advantage for those who are able to discern the opportunities. So in our macro investor program, we will explore how to identify the opportunities and take full advantage of them. So I leave it back to Shane, who will continue from here to tell you more about our macro investment program.
All right, thank you very much, PC, for your wonderful sharing on the Global Economic Outlook 2020. And I'm sure by now, some of you here, or if not most of you here, will be very mind blown by the amount of knowledge and the information that was shared today. Maybe some of you here may not have heard some of the terms before, like unipolar hour, multipolar hour, or you may not heard about negative yielding bond and so on. And today is the first time you understand something new to you, and also some other geopolitical history and war between nations. So, but no worries, in our macro investor program, we will tell you more about it. Now, of course, we can't share so much with you, but we have so much more to share with you, but we can only do so much in 2 hours. So by now we are 10 minutes past 2 hours. If you will allow me to share one more program with you called Macro Investor Program, which is PC and I spend a lot of time and effort into doing this program for you, because we can't do so much in 2 hours, but we want to help you to become a more enlightened investor. Not only that you're aware of what happened in Bursa Malaysia, but also you're aware of the trends and macroeconomics around the world, so you can become an informed and also wise investor. By taking advantage of the developing trend, you'll be able to position yourself earlier before the trend breaks out, and then you can capitalize on the big gains subsequently. So that's what we aim to do in Macro Investor Program. In Macro Investor Program, we will share with you the macroeconomic trend and teach you how you invest not only in Bursa Malaysia, but also in the local stocks. So this program is only open for people who are really serious. So if you are convinced with what we have shared with you just now for the past 2 hours, then I'll encourage you to stay on for another 20 minutes where I'll share with you what this program is about. So before we talk about the program, let's share with you about some of our results. Okay, we practice where we preach. So in fact, we invested not only in Malaysia but also in global stocks. So in January 2017, we bought 30,000 shares of Jinchuan for 1,400 Sing dollar, and then we make 49% profit in 2 months. In the same period, also Sing dollar appreciate 1% against Malaysian ringgit. So in October 2015, we bought 500 shares of ABX, and then we sold it in August 2016 for 165% profit in 10 months with additional 200 shares to spare. And then we also cover this stock called Hopewell Infrastructure. So we bought 20,000 shares of Hopewell at 12,000 in December 2013 and also 2014, and then we sold it in September 2017 for a capital gain of 35%. And then in this period, we also received about 38% of dividends yield. Okay, in the same period, we also benefit from the Sing dollar appreciation, which is up 21% against the Malaysian ringgit. So when we also look into the gold miners ETF, we bought 200 shares in January 2016, and then we sold it in September 2017 for 64% capital gain. At the same time, Sing dollar also appreciate 2.6% against Malaysian ringgit. So we haven't even talked about the dividend yield in this case. So we also bought into 150,000 shares of UKOG with 2,600 Sing dollar, and then we sold it for 372% profit in 2 years and 4 months with 50,000 shares to spare. But in the same period, Sing dollar also appreciate. Now, for the remaining share, we sold 20,000 shares of UKOG for 3,000, which is equivalent to 788% profit in 2.5 years with 30,000 shares to spare. In the same period, Sing dollar also gained about 16.4% against Malaysian ringgit. Now, for the past 2 years, our portfolio is also up. For my portfolio for PC, PC is also up, but precise figure you can check with PC. But for me, my portfolio is also up 30% to 20 to 30% for the past 2 years. So in this regard, we practice really what we preach by investing in global macroeconomic trends, by going into the sector, by learning about ETF or ETF to go into diversify our risk. So in this program, we'll share with you how exactly you can do that without engaging in too much risk. So what you will learn in this macro investor program is that you're going to understand economic trend, learn how to interpret economic data. So learn how to compile your return in any economic situation, and how to have recession-proof investment growth. And then lastly, you're going to learn how to protect your asset and hedge your risk in global financial risk or even global currency reset. So we will talk about how you can strategize in an economic slowdown, how you can strategize in an economic recession, and what portfolio you should go to in the economic recovery, and what kind of stocks or sector you should go to when it comes to economic expansion. So we will cover strategy, investing strategy, and trading strategy in 4 different economic situations. So who is this for? Now, this is for working adults with capital to invest. Okay, like you who are tuning in online today, who are for business owners, for experienced investor, and also for traders who want to hedge their positions, and for anyone who want to create wealth in the market. So we want to encourage you, if you are anyone who want to create wealth in the market, we encourage you to join our macro investor program. So what will be covered in this 10 powerful modules? In module number 1, we will talk about global economy, emerging markets outlook, so that you can understand the big trends and invest in sectors that are likely to attract the hot money when the next paradigm shift occurs. Module number 2, we'll talk about economy masterclass. Now, some of you here may not understand what the jargons that PC or me use just now, but so by joining this economy masterclass in module 2, you'll be able to understand every single economic jargon where to source the data and are able to make sense of any economic trend and ultimately see the opportunities. We'll share you what are the sources that we refer to when it comes to data mining. Then we'll find all these charts and then interpret these charts together. In Module 3, we'll talk about power of ETF so that you know how to utilize this powerful tool to long and short the market with ease. In the past, we also talk about ETF, but mainly in Bursa market, which we have very limited. But then in the US market, in the US, New York, NYSE, ARCA alone, there are 1,700 ETF listed, more than the share listed, double the share listed on Bursa Malaysia. So we'll share with you how can you use this ETF, not only conventional ETF, but also inverse ETF, how you can short the market if there's any economic risk. In Module 4, we'll talk about strategies in economic slowdown so that you know how to short sell, learn what asset class to invest in an economic slowdown, as well as strategies to make money. In Module 5, we'll talk about how to get started in global investing so that you know how to start trading global stock, learn different brokerage platform, and then the exchange information. Now, for those of you who have not started in trading in global stocks, then this is a perfect opportunity for you to join our macro investor program so you know how exactly you can invest in a foreign market. Now in Module 6, we'll talk about strategy in recession so that you know how to make tons of money rapidly in a fast recession, because recession usually happen very, very fast. You see the bear market usually lasts maybe 1 to 1.5 years, and then the bull market will be extended maybe for 8 to 10 years. So in this Module 6, we'll share with you how we can make quick money fast in a recession. In Module 7, which we cover strategies in recovery so that you know how to pick up cheap and undervalued stocks in a recovery that will give you high dividend yield. Now, if you learn this module, you'll be able to pick undervalued yet that demonstrate growth. There's high growth but undervalued. When you pick the undervalued stock which are high growth, then you'll be able, your chances of making money is really, really very high. Now in Module 8, we will talk about strategy and expansion so that you know how to ride the trend in the bullish market and make massive capital gain. Like now, for the past so many years, the expansion is really, we have seen that the economy has actually indeed shown signs of slowdown, but then the stock market has also extended for so long, okay, for the bull run. So in Module 8, we will talk about how you can make money in this massive bull run. And in Module 9, you will learn how to follow the flow of money to sectors and markets that likely outperform. In this module, we'll talk about global shares and sector rotation strategies. And last but not least, in Module 10, we'll talk about how you can construct your portfolio and manage your money, okay? And learn how to hedge your position. So the total value of this macro investor program is $1,997 US, okay? But no worries, today we are making a special offer to you so that you can join, any one of you can afford to join this program. Now, so for this macro investor program, let me sum up, it's a 10 online modules. You can watch anywhere with good internet connectivity. The modules are conducted by PC Wong. 70% are done by him, but 30% are done by me. So not only has these strategies worked for us, but it has also worked for some of our students. So for case study number 1, you say that by using growth investing strategy has helped me to achieve 120% return in 1.5 years time. It's my best return so far, thanks Shane. So he's one of our students. So case study number 2 is from our student called Wilson. So this program, he said that this program is very unique as that it teaches us sector rotation that you can't find in any other investing program. Shane is a very good trainer that always ensures every participant understands what is being taught. I would recommend this program to anyone, whether you have any investing experience or not, as it helped me discover new strategies in my investing journey. In case study number 3, we have one more student from South Africa who came to Malaysia to learn. Now, this program answered a lot of my questions that other tutorials and gurus haven't been able to answer. I'm now more confident to invest in the stock market, and I highly recommend it to others to join this program, Shane and PC. Now, in the past, we do this in a live session. That means we charge a few thousand to join this program, but now we make it affordable online so that you don't have to attend classes. You can only tune in online at an affordable fee. Now, another case study is about students from studying in Sabah. So he made 26% return in 3 months by learning from our program. Okay, he said that thanks to PC and I. All right. So, but not only we want to offer you all these 10 online modules, but we also want to give some bonuses for you to enrich, to enhance the package and deliver more value to you. Okay, so in bonus number 1, we will also have a Facebook community whereby every week we'll give you economic update. Now, if you have no time to read the news, to read Bloomberg, CNBC, Reuters, or other alternative media for a fairer point of view, then you watch out for our economic update every week. Okay, every Saturday. It's valued at 197 US dollar. Now, this is one example I posted in the group whereby one of our students said that thank you, Wong, which means PC, for sharing such accurate predicted with your well-supported research facts. All right. Now, in bonus number 2, okay, we will give you 6-month Inner Circle subscription. So this will involve stock picks and alerts. It is valued at $97 a month, which is valued at $582. Okay, so that means that not only we want to help our students to get started, not only that you will learn about macroeconomy, but we also want to share with you what are the stocks that we are observing right now. What are stocks that we feel that will be beneficial for the upcoming trend. Okay, so in this, by joining our Macro Investor Program, we extend this 6-month subscription to our Inner Circle complimentary. So this is alone is already valued at $582. So this is our stock pick result for the past 1 year and 9 months. We have covered about 79 stocks, 79 ideas for you. Now, all of these 79 stocks, it doesn't mean that all stock that PC and I invested in all 79. In fact, we don't invest in all, but we invest in a number of them. Not because that we can't, just because that, not because we can't, but we're not able to because we don't have so much. Some of our stock have not been sold. So we cover stocks that interest us, and then from our track record, our 79 stocks we covered, about 84% of them is gainer, while 15% lose money. Out of which we have 2 stocks that make more than 100% gain in the past 1 year plus, and then there are 10 stocks that made 50 to 99% gain out of the 79 stocks that we covered. The biggest gainer so far is 115%, but the biggest drawdown is negative 50%. Now the last 2 years, so this is the track record. Okay, some of the multiple gains that we achieved include the First Majestic Silver that we covered in April 2018, China Communication Service up 6%, Advanced Semiconductor Manufacturing up 82.9%, China Mobile is up 25.7%, Chengdu Aviation is up 34.9%, Epstar is a satellite company that do satellite is up 28.4%, Avic China is up 30.4%, Barrick Gold is up 72.3%, Pan American Silver is up 64.6%, the Global PAX is up 33.3%, while PC Group is up 100%, while Meituan Tianping is up 114.8%, while Metalla Royalty Streaming is up 67.5%, while Barvest, this is a Malaysian company, is up 41%, and Hua Hong Semiconductor is up 50.4% in just 2 months that we covered. All right, so this is some of the stock that we covered before. So now, as you can see, many of the companies here are not listed in the US, while we have a number that listed in US, for example, Barrick Gold, Pan American Silver. But you have seen that many Chinese companies. So these Chinese companies are mainly mostly H shares, which are traded on Hong Kong, where you can actually participate. Okay, so not many courses really covered Chinese company, but we believe in the future of China. That's why we covered Chinese company which are undervalued and have huge potential. Some of it are also state-owned enterprises. So these are the track record that we have. And then, of course, sometimes when opportunity prevail, we'll give some trading ideas to some leverage ETF or inverse ETFs. So these are some of the leverage and inverse ETFs they have covered before. They have made about, because leverage inverse, we don't usually advise you to hold for long. So it's usually for a trading period. Okay, so this is some returns. Some are up 50%, while some are up single digit in 1 or 2 months time. Of course, we also have some losses. Not all companies make money. So these are some of the losses that we have in some of the stock recommendation that stock idea that we gave Some are down 29%, some are down 15%, and one of which our most biggest drawdown is McDermott, which is only one of them, which is only the only one that's down more than 30%. Okay, it's up down 50% because many of the suppliers of this company, which are shale oil related, went bust, so they can't pay this company. So bonus number 3, okay, we give unlimited access to lesson with periodical updates. Okay, so that means if you don't understand a certain module, you can go back and revisit, and then every periodical will upload a webinar that is macroeconomic based to the portal, so that you all can stay abreast of the latest development of the market. So we will upload our trade war. We'll do a trade war webinar and upload in the portal so that you can all watch it, so that you can keep yourself abreast of the latest development. So this is what happened when you join this program. Not only is it one-time revision, but you can revisit the module as many times as you can with periodical updates. So let me sum up with what you're going to get. You're going to get the 10 module of the Macro Investor Program that's valued at $1,997 US. Then you're going to join our Facebook community, because sometimes trading alone could be very lonely. So we want to put you in a community where every week we will update you with the economy update, so you can stay alert with the latest update. Okay, then you'll be able to join our 6-month Inner Circle subscription that is valued at $582. So we'll share with you our premium equity research every month. We'll talk about 2 to 3 companies that we feel is worth investing. For the past 1 year and 9 months, we have achieved about 84% of success rate with some of the companies that we share. So unlimited access to lessons with periodical update. This is valued at $297. So you can do revision. We upload a periodical update to our Macro Investor Program. Okay, so in total, the value is $3,073 US. But today, of course, if I were to charge you this amount dollar, I think many of you will not be able to afford to join this program. So of course, today we are running a special promotion. Okay, so we give 90% off to our original price at the original value of $3,073. So today promotion before 11:59 p.m. is only 1,297 ringgit. Okay, and subsequent packs is 1,597 ringgit. Okay, when you buy this program, you can also share with your wife, with your children, so many of them can also learn together with you in this Macro Investor Program. So please, if you are ready to enroll, please go to www.macroinvestorprogram.com/go. Okay, please write down this, www.macroinvestorprogram.com/go to enroll today before 11:59 p.m. After today, we may take down the offer. Okay, so the enrollment is open today at before 11:59 p.m. Please enroll, www.macroinvestorprogram.com/go. All right, so it's at 1,297 ringgit. So let's talk about, let me just spend another 5 more minutes to talk a little bit about why you should join. Now, why you should join, because now, if you are going to explore the foreign markets on your own, maybe you're going to do it with trial and error. When you go to do it trial and error, you might at the end make mistake, and when you make a mistake, it costs you money. And then, you know, making a mistake in capital market sometimes could be costly. Of course, if you test with a small account, then you might not be able to make so much, because the transaction cost also will be quite substantial to you if you only trade like $500 US. Okay, so we encourage you to come to learn first, because if you can get somebody who have traded before, invested foreign share before, then you will be able to condense your learning so that you'll be able to avoid the mistake that we make, and then to accelerate your growth. For example, when I first approached leverage inverse ETF many years back, I made mistake that cost me a few thousand loss in terms of the US dollar, okay, a few years back. But now I've learned about how you can better use the inverse and leverage ETF. Then I'll share with you so that you won't repeat the mistake that I have made. Okay, so by having a mentor, you don't have to do trial and error on your own, but you have a community that can support you, and then you'll be able to avoid the mistake, avoid burning the money. When you burn the money, it could be a few $1,000s like I did many years back. If you join this program by only 1,297 ringgit, not only US dollar, you'll be able to avoid the mistake that we've made. Okay, and then either way, you got to spend the money. Okay, you either give it to the market by your mistake, or you really invest it in yourself so that you can acquire knowledge that can be used for a lifetime. Now, I want to talk about why we should invest and diversify abroad. If you look at the Kuala Lumpur Stock Exchange, which is Bursa Malaysia, for the past 5 years versus the S&P 500, which is the largest 500 companies listed on the American markets, we see that for the past 5 years, American market is charted by the blue line, is up 58.2%, while the Bursa Malaysia is down negative 7%. Okay, this is the past 5 years. If you have traded Bursa long enough, you know that our KLSCI has been dropping. For the past 1 decade, we are down like 8 years, only like 1 or 2 years that we are up in 2017. And then, so you see that if you only focus on the Bursa Malaysia market, which is the local market, sometimes we miss out all the fantastic opportunities in other market. For example, we covered some of the tech stock in America before, such as Alibaba. We talked about Apple. So Apple, you see, Apple literally doubled in 1 year. But then now we see that how can our blue chip stock double in 1 year? It's not that easy for a blue chip stock to double in 1 year. But in the American market, we can see that big company can still grow at a faster pace. So if you only look at the Malaysian market, then you might miss out opportunity elsewhere. But of course, recently we do more research into the Chinese market because we believe that the Chinese economy is going to pick up. If you're not going into China, not investing in China, then you might be losing out. But of course, investing in China, there's timing risk, so we will explore about that. Okay, now American market, like what PC has shared just now, is settled with that. So right now we do not cover much about the American market except in the mining industry and resource industry. But if you talk about as far as tech industry, we cover both US and China. Like we talk about AI, robotic, Internet of Things, then we cover both markets. But generally, we will share with you more on how you can benefit from the Chinese market as well as a little bit of the US market. That's what our inner circle is all about. So for our currency risk, if you don't invest, you only invest in a Malaysian market, then you have, if ringgit depreciate, in which it had happened in the past 7 to 8 years, then you see that we lost money. Okay, if you invest in property that grow 30% in 5 years, but your ringgit depreciate 30% in 5 years, then you actually don't make any money. You only break even. Okay, so by investing abroad, we can capitalize on the strength of the other currency, and then we can make double whammy gain. Okay, so now let me ask you, how much of your asset are in your local currency? Of course, you don't have to answer me. Just think about it. Are you 100% invested in a local market? Or it's time for you to think how to diversify abroad so that you can safeguard the value of your currency by investing in foreign denominated asset. So as we have covered, as Fisher covered just now, I think we have seen that there's enough risk in the market where we see that the inverted yield curve happened last year. When inverted yield curve happened, usually it takes about 12 to 18 months before a recession hits. This year is going to be crucial, not next year. This year is going to be crucial. Maybe the run out of the market could stop at 30,000, could stop down at 30,000. And then I think the risk will become really big after the US presidential election. Okay, whether whoever wins the US presidential election, I think the market is likely to tank as well. So I think the risk of a recession is really substantial right now. So if you look at the P ratio compared to the stock price, Now, if in a Great Depression, this is Fortune 500 companies, this is S&P 500 Shiller P ratio. If you look at during Great Depression, the S&P 500 P ratio is at 30. In the dot-com bubble, the S&P 500 is at 45. Okay, in the subprime crisis, it already crashed at 27. Now, right now, as of 4th of January 2020, our P ratio at 31. Okay, so which are at a second highest after the dot-com bubble. So now the risk is really very high now. So what will cause the burst? We don't know. But when there's a burst, there's an opportunity, because many of us have been waiting for opportunity for us to buy low. Okay, when bear market comes, we can make big money during the plunge, and then after that we can become a value investor like Warren Buffett to pick up a lot of good company at a good quality company at a reasonable price. As of now, the Berkshire Hathaway, which is a Warren Buffett company, has about 100 billion in cash. Never in the history of Berkshire Hathaway has the company has so much cash, because there's not much things to buy in America. Everything else is so expensive. That's why the Berkshire Hathaway Warren Buffett company is holding so much cash to buy into value company when the price correct. Okay, so be prepared to brace yourself for the storm. So now my last question is, will wealth disappear? The answer is no, because wealth is like energy. It will transfer from people who are knowledgeable to people who are transfer from people who are not knowledgeable to people who are knowledgeable. Okay, if you know how to position yourself, if there's any recession happens, any financial crisis happen, then you'll be able to make money from the people who are a bit more ignorant or less knowledgeable. So wealth will not disappear. Wealth will just transfer from people who are ignorant to people who are enlightened and people who are prepared. So are you prepared? Okay, in our macro investor program, we'll share with you how you can prepare yourself should an economic recession come in. So where would you have spent? You probably spend this 1,297 in a car, but I want to compare it versus an investment that can feed you a lifetime. Okay, 1,297 probably a month installment for your Honda Civic, okay, or your Toyota Vios or Altis. But if you invest this amount into our macro investor program, you will learn the knowledge that will be able to feed you a lifetime. So be sure. So I want to encourage you that to acquire this knowledge by learning with us, so that you're able to prepare yourself when the economic crisis is coming. So what are you going to get? Okay, you're going to get a macro investor program. Let me recap: of $1,997 in value, which consists of 10 modules. Will teach you strategies in economy expansion, in economy slowdown, economy recession, and also in economy recovery. So you're going to join our Facebook community, which will give you weekly economy update that will save you time and energy to study the news. So if you have no time to study the news, you have no time to read, to stay abreast of the market, you only need to read our update every week on our Facebook. Okay, then you can join our 6-month inner circle. Not only we want to teach you how, but we also want to give you some fish in the beginning. All right, so we'll share with you our premium equity research by sharing with what a company that is worth investing right now in the current economic situation. Now, we also get unlimited access to lesson with periodical update by joining our macro investor program. So total value is $3,073 US, but today you will get 90% off by only $1,297 ringgit. Okay, if you're ready, please head over to www.macroinvestorprogram.com/go to enroll into this program. Okay, so again, go to www.macroinvestorprogram.com/go to enroll into this program. Now, some of the frequently asked question is, Shane, what are the likely results that I can achieve? Okay, so by following our recommendation in our stock that we cover, you don't have to I would estimate that you can target about 20% return a year, okay, in a normal inflationary period. So that's the target, but of course, target set, then you must act to make sure that it achieves. Okay, last year my US and China portfolio is 2019 is up about 30 over %. Okay, so that's for my result. So number 2, I'm totally new to investing. Is it suitable for me? Okay, so if you are totally new to investing, if you're totally new, you got zero experience, and you've never traded, then it's not suitable for you. Okay, if you're traded in Bursa and you want to learn how to invest in US, then okay, you can join. But if you have zero trading experience, then this program might be a bit too advanced for you. Okay, so if you're totally new, then you may not find. You can still join, but you will take more time to understand, but you need to revisit a couple more times. Okay, so if you're ready, please go to www.macroinvestorprogram.com/go. If of course you have trading experience, investing experience, you want to diversify abroad, please join our www.macroinvestorprogram/go. Okay, the offer is only available before 11:59 p.m. After which it will be raised to 1,597 ringgit. With that, this is Shen Chu signing off today. Okay, I want to thank all of you for paying attention until the end of this webinar, and I wish you all to achieve success with stock investing. And then I'll see you again in our next webinar. See you at the top. Bye everybody. See you in
Bye.
our macro investor program.